Great. So welcome you all once again to the question solving section of the IAS 20. That's the government grants. So IAS 20, government grants and disclosure of what? Government assistance. So if you look at the meaning of government and then the grants and then the government assistance. So let's see. We'll look at November 2017, the past question first, and then we scan through some few questions in the handouts. Then we are done. Good. So let's see, November 2017, question 2. Before the November 2017 question, there's a nice one in here. So you can put that one. I'll still come to November 2017. But there's nice one in here that I want us to look out for. So first, let's confirm the year so that when you are studying, you'll be fine. That's May 2013. Yes, May 2013 or November 2013. Question number. Okay, it's November 2012. November 2012. November 2012. That's question 1B. Question 1B. November 2012. And here comes the question. I'm reading. November 2012. Good. Please, if you do have your past question which you can open alongside, oh, they are very good. Okay, here comes the question. A company received two separate grants during the year from the United Kingdom government. The first grant, an amount of 500,000, was given to acquire an electricity plant, whilst the second grant of 50,000 was to support the training of the electrical engineers on the electrical plants. Good. The plant was estimated to have an economic life of 25 years. Detail out required. Detail out the a treatment, in fact, it's supposed to be the accounting treatment of the above events in accordance with IAS 20, accounting for government grants and disclosure of what? Government assistance. So who can inform us this treatment? So here there are two issues in here. So detail out the accounting treatment. Here is over 25 years. Format. So if you pick the first grant, an amount of 500 that was given to acquire. So that one becomes what? Grant related to what? Asset, right? Which is called capital grants. What's the treatment of capital grants? Good. Then the second one, an amount of 50,000 was also awarded to support the training of the electrical engineers on the electrical plant. So that means that one becomes what? Revenue grants. Good. So now let's tackle them one after the other. So let's tackle them. 4 marks. So you should write something like, so good. Now let's go to the board. So first, there's a capital grant of 500,000. And then there was a revenue grant of 50,000. So just have to tell us the accounting treatment of the capital grant. The accounting treatment of the capital grant. Good. Now for the capital grant, the standard allow for two treatments. That is the deductive method or the deferred income approach. Good. Or deferred credit approach. So here, the grant is either net off from the capital cost of the assets. So just that the acquisition, the sum of the capital cost of the asset is not given. So it means that we can only adopt the second method. That's what the deferred credit approach. Good. So here we have to use what we call the deferred credit. So this grant with the deferred credit, the entire grant will be what? Will be amortized over what? Over the period. Will be amortized over the period or over the useful life of the assets. So this grant will be amortized over what? Will be amortized. So amortized over the life of the assets or the life of what? The electrical plant. Over the life of the electrical plant. Good. Which is what? 25 years. So 500,000 over 25 years. And every year, a portion will be released to the income statement. Every year, a portion will be released to the income statement. So that will be the treatment. Every year, a portion will be released to the income statement, with the remaining balance being set as what? Non-current liability. So here, the relevant entries will be like this. First, the entire grant must be deferred on the life of the asset and amortized to the extent that every year a portion must be released. So when you go to the income statement, you go to your other income, then you record grants. So I'm doing for just for the first year, and it will be the same throughout. So you pick your calculator, you tell the examiner that the entire grant received is what? The entire grant is 500,000. So therefore, it will be 500,000 divided by what? 25 years. And that will give us 20,000. So every year, 20,000 must be released to the income statements. So year one, 20, year two, 20, in that order. So you release them to the income statement. Great. Then what do you do? Then when you go to the financial position, that's the balance sheet, you go to your non-current liability, you write grants. And you go to your current liability too, you write grants. Now the entire grant must be set as what? As a liability, and every year a portion must be released. So that means year one, year two, up to the very last year, year 25. The non-current liability section will be, so what's the entire grant? 500,000, right? And first year we release 20,000 to the income statement. So let's that much. Let's 480. And out of this 480, you have to separate them into two. So here what you do is this. To be on the safer side, just record the total here like this. 480,000. And ask yourself that this 480,000 have to break them into two. A portion must be released to the a portion must be at the current liability and a portion also be non-current. Just that always the current liability section is the one that we are going to release next year, which is what? The one that we are going to release next year. 20,000. Good. So I will call it here 20,000. So if the total liability is 480 and 20,000 is current, non-current will be what? If 20,000 is current, then non-current will be what? 400 and what? 60,000. And then when you go to the year two, so year two, they've released cumulatively 40,000. So levied what? 460,000. Out of the 460,000, 20,000 will still be what? Will still be current liability. Then on non-current will be what? 400 and what? 40,000 in that order. So this is how we'll explain the accounting treatment. You don't need to go through all the 25 years. No, just the first year. You're telling them that first, the entire grant must be set as what? As a liability. And every year, a portion will be released to the income statement, which is what? 20,000 Ghana cedis. With the remaining balance still be set as what? As liability. You are done. It ends there. Qualify for what? 2 marks or 3. Then you are done. Then go and pick the 50,000. Good. Now if I do one, you do one. Uh, Now the 500,000. So tell me the 50,000. How you're going to treat the 50,000 to? Great. So of the second one, you can select any of the two methods. Whether that one has to do with the classification or the presentation, how to present the grant. So the presentation. So you have to credit to what? To the income statement. So you credit to the income statement. That is means you add it to what? The other income. In this question, that one will be the best approach. How we get it? Yes, that's the best approach. Because there are two methods. And then all of them, one will be very good for this particular question. For grant related to income, there are two methods. What are they? We have what? The deductive and what? The income credit approach. So you have to use the income credit. Why? Because here, the deductive, you have to get the related expense, then you subtract it from the related expense. Here, there's no related expense here. So the best approach is to what? Credit to what? Your income statement, as someone writes there that. So you have to credit the 50,000 to your what? Income statement. We are done. That is the end of this. Going forward, 4 marks. Good. Now let's look at the next question. So we go to November 2017. We are still at where? 2000 and what? 12 November. So we did it like that. Good. Now let's look at the November 2017 Bosco or question number 2. So A is on IFRS 5 held for sale. B is on inventory. This question is a home. Okay, it's not homework. We try. Or it's homework. Either it's homework or we've tried one of them. Good. This question, that's the B. SNAM, which is in the handouts. C. Ayariga. This one is homework. I've not received the solution. Okay, don't worry. Everything will be fine. Let's November 2017. And then let's go to the D. The D is Bosco Aluwex Limited. Okay, great. It's an interesting question. It's an interesting question. So we will look at this to detail. From there, then we scan through other sections too. Good. Okay. Now let's look at the question. It says this. Required. Explain how each of the above should be accounted for in the financial statement of what Bosco Aluwex Limited for the year ended 31st April 2000 and what 17. I like the question. In accordance with what IAS 20, accounting for government grant and disclosure of what government assistance. Now, both student and examiner, when you code the standard, have to write the name. So have you seen when the examiner code it, writing the full name for you. So in the exams too, maybe you want to use this as a test reference. Please try and write the full name over there. Don't just quote IS 20 says this, then you are done. IS 20, what is there? Good. We don't want trouble, don't quote. Just say whatever you want to say in just a normal, ordinary language, ordinary statement. No quoting. Good. Now let's go to the issue. Bosco Aluwek Limited, a manufacturer and supplier of what? Aluminium utensils for household, has recently established a new facility in Kumasi. To help in this new operation, Bosco Aluwex Limited have secured a number of grants from the government of Ghana and are unsure how the grants are to be accounted for in the financial statement. The company has a year-end 30th April. Wow. Okay. 30th April 2017, and all the following transactions took place 1st May 2016. Let me make some. Let me. So let's try and then take note that April have 31 days. April is having 31 days, not 31. So let's take note of that. Good. Hmm. That's interesting. That doesn't mean that you don't solve the question. For minister, you don't even see it on the exam through. Don't even see. You are very wide solving the question. You say 30th and 31st. Come on, good. Now let's move on. The company has a year end of 30th April 2017, and all the following transactions took place at 1st May 2016. So it's still within the year. That's the that's the beginning of the financial year. Bosco Aluwex Limited has been awarded a grant of 80,000 to be received over 3 years in respect of providing employment to what fresh graduates in the area. So how do you treat this? Is it a capital grant or is it a revenue grant? Yes, revenue grants, and then this is a situation where the condition has not been what satisfied. The condition will be satisfied what within relevant range. So here you just have to tell the company that say explain how each of the above will be accounted for. So for the first one, they just have to relax, and then it will be what amortized over the 3-year period. Every year, a portion must be released to the income statement, or they can also amortize it over the number of what people employed. Just that here they didn't give a quota, so the quota is for 3-year period. Good, so that will be the quota. The second one, Bosco Aluwex Limited received a grant of 5,000. Received a 5,000 grant from the Ministry of Business Development for the initial training of the new employees. Initial training of new employees. So here, how do you treat this grant? Is it a capital grant or revenue grant? This it relates to what we saw first, right? What we saw first was 50,000, but this one is what 5,000, and all of them were training, right? Good. That's Rupito Rupiato. Great. We call it Rupito Rupiato. That means it's like look alike. So the amount is 5,000, and this is to of training for the initial or the new employees. Just that here, this training, we are not going to award all of them at the start of the year because we're going to train them for the 3-year period. Each and every year, you recruit new staff and you have to train them. So they are awarding you 5,000 for the initial training of the new employees. So it must also be amortized over the 3-year period. Agreed. That 5,000 must also be amortized by the 3-year period. Good. Let's go to the third one. The company also received a grant of 120,000 from the Ministry of Special Development Initiative towards the acquisition of a 600,000 machine. Wow. The machine has a useful economic life of 8 years. An estimated residual value of 60,000. Depreciation is on straight line basis. So this one you start with. You are doing the third. I've done the first and second. So let's start. Let's put some few stuff together. Good. I've done one and two. Do the three for me. Even though I'll do it. Either let's try and put something together. If you are watching too, you have to pause the video. Good. If you are do watching, please pause the video. Good. Now let's do it together. Let's do it together. Now let's solve all of them. So we've done the I and then the II. Just like the second one, Bosco Aluwex Limited received a grant of 5,000 for the Ministry of Business Development for initial training. So that's the first year training. If for the first year training, what do? It must be credited to the income statement because in the year that you fulfill what the condition. That's when the condition is satisfied, you credit in there. But if because you're going to employ the graduate for 3 year period and then anytime you employ them, you have to train them, then you have to also share this 5,000 over the 3 year period. But here, this 5,000 will be recognized in the first year, to be recorded in the first year. Why? Because it's to cater for just the initial training, meaning the first year training, not the second year, not the third year. So, however, the entire amount must be credited towards the income statement as what? As grants. Meanwhile, the 80,000 will be spread over the 3 year period, and every year a portion will be released to the income statement. You are done. Good. Now let's go to the third one. The third one is the grant relating to what? Assets. So here, all what you have to do is you have to get the details of the transaction and then select which method. Yeah, any of the methods will work. So the first one will be the cost of the asset is 600,000, grant of 120,000 was given, and then the scrap value is also 60,000. So here, if I use the deductive approach, that's the most simplest one. The deductive approach. First, all we have to do is original cost of the assets, which is what? 600,000 less grants, less the grants received. The grant of 120,000. So therefore, what do you get? You take it off. So when we subtract, what do you get? Good. Now, so the net amount will be net cost of the asset will be 480,000. So depreciation must be based on this. So in that case, depreciation will be that's 480,000 less what the scrap value of 60,000, all divided by the useful life of the assets. Good. That will be, let's go and pick the useful life of the assets, which is what? 8 years. And the economic life is 8 years. So therefore, I'll divide this one by 8 years. Then that's all. The rest, you find the carrying amount. It ends there. The grant must be added to the cash book of the entity. So that will give us good. So that will give us 420,000 divided by 8. So 420 by 8 is 52,500. So that will be the solution. That's the depreciation per year. If I'm using what? The deductive approach. Now let's assume that you are using the other approach. What's the other approach? Is method one, alternative method two. That's what we call the deferred credit approach or deferred income. The deferred income approach. The entire grant must be depreciated, which we term it as what? Or we call it amortization. The grant must be amortized. Grant must be amortized. Good. Then in the P&L, so we write here depreciation. The depreciation will be based on the original amount. The original amount, which will be year one, year two, up to year eight. The original amount is what? 600. So depreciation based on 600. So therefore, you take on the scrap value of 60,000 from it. So it will be the 600,000 less the 60,000 all divided by 8 years. So if we're using that approach, that will be the depreciation per year. Good. And that will give us, that will be 540 divided by 8 years. And that will give us 67.5. So 67,500. Then you go to grants. The entire grant must also be what? Amortized as usual. So the grant is what? 120,000. So 120,000 divided by 80 years. Every year, a portion must be related to the income statement. So therefore, 120 divided by 8, that will give us 15,000. So a gain of 15,000. So the answer will still be the same. There was the depreciation of 67,500 less a grant of 15. It will give you or return you back to us 52,500. So you realize that you make a clear statement that whichever approach that you use, the net answer is the same. But if you use this approach, there's a depreciation of 67,500. The grant was depreciated to offset it. Good. Over here, we just take all the grants from where? From the cost before we calculate the depreciation. So that is the end of the game. Then you amortize it. So the entire grant will be set as a liability, non-current and current liability. Every year, a portion must be released to the income statement. Then you are done. Good. Now, with the life of the grant, yes, will be always equal to the life of the asset because the grant will be spread on what? On the useful life of the asset. So it will be amortized over the useful life of the asset. So the grants have to be spread over what? The useful life of the asset. So definitely the life of the grant will be over the life of the asset. Great. So basically that is the game. Now I promise that I'll scan through the handout too to pick some few stuff from the handout. So let's see if we can get some few stuff from the handouts. And now there are a lot of questions in it. Try it for me and then you'll be fine. You'll be fine. Now, going to tutorial question 7, randomly. ABC company obtained a grant of 10 million from government agency for an investment project to construct a manufacturing plant of at least 88 million. The principal term is that the government is that the sorry, the principal term is that the grant payment relate to the level of the capital expenditure. The secondary intention is to safeguard 300 jobs. The grant will have to be repaid pro rata if there is underspending on capital. 20% of the grant will have to be repaid if jobs are not safeguarded. Within 18 months after the date of last asset purchase. The plant was completed on January 2008 at a total cost of 90 million. The plant had an expected useful life of 20 years and is depreciated on a straight line basis with no residual value. ABC company adopt the policy of what? Certain government grants up as deferred income. Wait, so that's the now show the relevant income statement and statement of the financial position extract as well as relevant disclosures in the 2008 final account. So account for the above ones. Now what left is the repayment of grants. That came in corporate reporting level 3. That is the 2017 November. That is same year. So the year that the grant came in financial reporting at the level 3 too, it was also was there. So that year was a very good year. So came in level 3 and level 2. That's the repayment. So I'll bring that one and then try and do justice to that one too. So that the repayment section mostly been asked at the level 3. But it's good that you go through it at the level 2. So when you get there, you'll be fine. Good. So you try all these ones for me. There are nice questions here. Nice, 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 nice. The answer part two is also there. Good. Okay. So that is great. So this is the end of the IAS 20 government grant. The first section of the question solving. Now we'll be quickly looking at the IAS 23. That's the borrowing costs. Good. IAS 23 borrowing costs. As usual, I'm going straight to the question solving stage. Good. If you are not following, don't worry. Or if you're not getting it, don't worry. It means that you have to go through the tuition stage or the first aspect of the lecture to grab it before you come and then go through this section. So that is it. Let's look at the borrowing cost. Question solving on the borrowing cost. Good. And then you are fine. Now, IS 23, question solving stage of IS 23, borrowing cost. If I've not gone through the tutorial stage of the IS 23, can you do so? The video is available. I will link it at the video description section so that you can just tap on it and go and watch it when you're done. You come up to this and you're fine. IS 23, very interesting. And please, it's one of the critical ones for this sitting. IS 23. Good. IAS 23. Borrowing cost. IAS 23. Borrowing cost. IAS 23. Borrowing cost. Now, a quick summary. We said that borrowing cost what? Prescribe the accounting treatment of what? The borrowing cost. That's all. So the accounting treatment of what? Borrowing cost. Then you are done. Good. Now what you have to do is this. You should know what the borrowing costs are, right? What borrowing costs are. Now they are the financed cost or interest and other costs incurred when entity what secure finance or in connection with the borrowing of what funds. So if you go and then public preferably debt, if you secure funds through debt, any cost incurred, we call it what borrowing cost. So interest and any other cost when you secure finance. Good. Normally you can also incur it on equity, but we are considering the debt here. So basically that is it. Then we also talk about the accounting treatment of the borrowing cost. That's a recognition. How do you treat borrowing costs in a question? We also said that there are two treatments. We have what? The old treatment and the new, right? That's the traditional treatment and the benchmark or allowed. So I think I've reasoned out. The traditional is the same as the benchmark. Good. Then we have the allowed or the alternative treatment. Allow or alternative. Basically, IAS 23 is the alternative. This is the IAS 23 alternative. Now the issue is, how do you treat borrowing costs, interest, and any other cost you've incurred? Please, when they ask you to define borrowing costs, don't go and tell them that it refers to the interest. Interest and other costs. Example could be what? The interest that you are paying, and then what? Finance cost on lease, administrative charges. Normally, I add my own and I tell me to go and come. You know, the bank, if you're going for a loan, today bring this document, tomorrow bring this document. All the time that they are wasting is also a cost to you. You could have used to go and work somewhere and get the money. So all of this I have classified to be what? Borrowing cost. So if you're going to search for a loan and then they're just tossing you today, tomorrow, tomorrow, today, in that order, by the time you realize, instead of you using just a month, 6 month period, you know, that 6 month period you can work and get money. So all of this factored in, your time wasting is also a cost. So just that. So borrowing cost refers to the interest expense, the interest and any other cost incurred in connection with what? Borrowing of what? Funds. So that's all. Administrative charges, processing fee. Some of the loans you have to pay a processing fee or administrative charge before they can give you the loan, or they will discount it. So they will give you 1,000 Ghana, they'll give you 900. So that the management commission fee of 100 Ghana has been deducted before they give you the net amount. All of these are what? Borrowing costs. Good. But for IAS 23 purposes, we are going to consider the interest. That's for IAS what? 23. We are going to consider the interest. Traditional or benchmark treatment simple means, or it states that all borrowing costs must be expense. Or what? Borrowing costs must be what? Expense. Traditionally, if you incur borrowing costs, go and what? Expense it. If you incur borrowing costs, go and what? Expense it. You are done. That's a traditional treatment. Then something happened in 1982 where they issued a draft version of the IAS 23 in 82. That's November 1982. Please, you don't need to know all the dates. It's not part of the game. The date is not part of the game. Now you are looking for the accounting treatment of what? Borrowing costs. How do you treat borrowing costs in a book? Or how do you recognize them? These are the accounting treatment. There are two types of the accounting treatment or the recognition criteria. So we are saying that, in fact, we have what we call the traditional treatment or the benchmark treatment. That's what we used to do before IAS 23 came into being. So all borrowing costs were what? Expense. So here, expense all borrowing costs. You expense all borrowing costs. Good. Then the second treatment is the allowed or alternative treatment. And that one is as a result of IAS 23. And IAS 23 started from 1982 November. That's where they issue what? The exposure draft. Then in 84 March 84, the actual standard was what? Published. And it take effect from 84, March 84. Good. Then in 2007, in fact, it has gone through several updates. In 93, they did add updates. 95, the same thing happened. But the major one was 2007. In 2007, they updated the IAS 23, which include the capitalization of the borrowing cost. So the allowed or the alternative treatment states that some, unlike normally I use capital letters to write. So here to capital letters, expense all borrowing costs. By here, some of the borrowing costs eligible for capitalization must be capitalized. So here the borrowing costs that are eligible for capitalization must be what? Capitalized. So some of the borrowing costs eligible for capitalization must be what? Must be capitalized. So capitalized. Now, capitalized means they have to treat it as what? As asset, add to the cost of the asset. That's all. But here there's condition. So in March 2007, when they revised the IAS 23, and then we start capitalizing the borrowing cost. Good. Capitalizing the borrowing cost. Now, the IAS 23 have gone through several updates. But in November 2017, yes, there was another update on the IAS 23. Please don't need all this. Yes, that one is irrelevant. All what you need to know is what you have to do under that one. Then you are done. Now, IAS 23, in fact, actually start from here, is saying that some of the borrowing costs eligible for capitalization must be capitalized. Here it's not saying all borrowing costs must be capitalized. Those are what? Eligible. Those are eligible for capitalization. They must capitalize it. Now, the eligible ones are the one that you secured in the to fund acquisition of what? Acquisition or construction or production of what? Qualifying assets. Now let me explain all this. If you pick a loan of let's say 100,000 Ghana cedis, and then you are paying interest at the rate of 25% per annum. So the whole year the interest will be what? 25,000. Capitalized means you are allowed to add the interest of 25,000 to the capital amount of 100,000, so that the asset cost now be what? 125. You pick a loan of 100,000 to go and construct a qualifying asset, and you paid interest on that loan 25,000. So the allowed version is saying that this interest must be what? Capitalized. But the benchmark treatment, traditionally, it must be expense. So if you are using IFRSs, then you have to go by the alternative or the allowed version. Take note that this is no longer there. If you are not using the IFRSs, then you can go by the traditional or the benchmark. But if you are using the IFRSs, then you have to go by the requirement of the IAS 23. Good. So that is it. Now, the borrowing costs that are eligible for capitalization, they are the ones that you secured or the funds that you contracted to one, to acquire. The terms are to acquire, two, to construct, and to produce qualifying assets. Qualifying assets. That's it. So any loan or facility that you secure to acquire, to construct, or to produce qualifying assets, you are done. And likewise is what is qualifying assets. All this has been explained in the tutorial stage, so kindly use the tutorial video to get understanding. For qualifying assets is an asset that takes substantial time before to make ready. Asset that is not already made, it takes time, such as what? Inventory and production plans. Good. So that's all. So that is the accounting treatment of borrowing costs. When I ask you what is the treatment of the borrowing cost, just let the examiner that relax. According to IAS 23, some of the borrowing costs that are eligible for capitalization must be capitalized, or I can put all here. All borrowing costs that are what? Eligible for capitalization must be capitalized. You are done. That's the treatment. Now let's go straight to the capitalization and then we pick our first question. Then we solve. This is a summary. But make sure that you go through the first video before. Now there are two types of borrowing. We have a specific and what? General pool of fund. So I'll cite my own example here and we do justice to it. Good. Now there are two types of borrowing. We have a specific. So one specific borrowing. With this one, that's what I'm going to do first. Here you contracted a specific amount or a fresh loan or fresh facility to construct that qualifying asset or to acquire that qualifying asset. That's a specific word borrowing. And then we have what you call general pool of fund. If you understand these two, we are done. General pool of fund. Please, I have jumped the three conditions, and I'm assuming that you go through the tutorial stage. All the three conditions, I think I took my time and explained it in there. They are very important. It came in November 2017, one of the conditions. And one of them too also came in the year that the revenue is supposed to drop, telling them that the next time it will come in calculation form. Recently, one of the theory also dropped. I think that 2019 May. Yeah, 2019 May. So let's take note. So currently, this one is the humble plea that I want to follow it before you. So kindly go through the first video for me, and then if you do that, you'll be fine because those three conditions they are very important. Now specific, you go for new facility. New facility. General pool of fund is also called existing. You need money to construct a qualifying asset, and you have contracted some loans years back, and these funds, some of them are idle. Oh, then let me use it to construct the qualifying asset I'm looking for, or let me use it to acquire, or let me use it to produce the qualifying assets. So that is the general pool of fund, or using existing funds or specific borrowing. But my first question that we will solve, we are going to look after all specific borrowing. We are done. So let's start specific. Then when I'm done, we pick a question on what general pool of fund. Then when I'm done, put all the two together. Then we now solve question, mix. Then that's the end of the game. Then we are done. Good news. Okay, so specific. Let's set the question. I hope you know the formula, right? Okay, let me give you the formula. For the specific, if you want to calculate the borrowing cost eligible for capitalization, start by saying the interest. Bring the interest here so much. Then less what we call investment income. Investment towards income. Then you take it off. Investment income. So this is what the borrowing cost eligible for capitalization. This one becomes BC eligible for capitalization. Or borrowing cost to be capitalized. To be what? Capitalized. So if you have the loan amount here, you add to get the total cost of the assets. Total cost of the assets. This one becomes the overall cost of the asset. So assuming that the capitalized amount is 25,000, the loan is 100. So therefore, the asset value becomes 125. That is it. So this is the formula that we are going to use to calculate the specific borrowings, and then we are done. Now let's give ourselves an example. This one I'll explain it. Now investment income. You pick 100,000, but you didn't give all the money to the contractor or the engineer. The 100, first you give the engineer 20, left with 80, right? Give the engineer 50 again, left with 30. The remaining 30, you give it to the engineer at the last day. I'll be get it at the last day. So it means that after the first amount, you still have 80 Ghana cedis. So go and invest it until the next what stage, right? Good. So you're going to invest this 80 until the next payment. After the next payment, you invest what? Another 30 until the next payment. So this investment income, at least it must save, or it must offset, or it must match or cancel some of what? Some of the interest that you are paying. That is it. So that's all. Now let's set our question. Very nice. Nice question. Very nice question. Very nice question. So here, in fact, I'll not talk plenty. The name of the company is Target PLC. Target PLC is Target PLC took an of amount of 120,000 cedis from Yansan Bank. From Yansan Bank. Yes. From Yansan Bank to construct office complex. To construct an office complex at what? Kaneshi. Good. That's the head office. That's the head office. Now, let me include it. On 1st January 2018. So the funds, we pick the funds from where? 1st January 2018. Good. Construction started. Construction started on 1st of February. 1st February 2018 and completed. Please, completed on 31st December 2018. Full stop. In exams, if the examiner did not inform you about the starting date and then ending date, assume that the day that they took the loan, that's where construction began, or construction start from that end. And then if they don't tell the completion date, you assume the last day of the year. Good. They don't tell you. I can also inform that it lasts for 2 years. So construction was completed when? 31st what? That's the last day of what? 31st January 2020. That's exactly 2 years from now. No. The contractor was paid as follows, or the amount was drawn as follows, or the following payment was made. I don't. It's not go there, so I think that one you have to write it. The amount was drawn as follows. So you start like this. So now on 31st January, on 31st January, we give the contractor an initial deposit of 20,000 to start the work. Initial amount of 20,000 to start the work. Then on 1st of March, 1st of March, we give the contractor 15,000 to buy certain material. Then on the last day of June, the contractor requested for some money and we hand it over to him. In fact, we satisfied 50% work, so we hand over, but we satisfy 60%. 60%. They don't give us 35. So we hand over 25,000 cedis to the contractor. Then on October 1st, we hand over, isn't it 40, 60. We hand over 30,000 to the contractor. Then on the last day that we inspect the work finally, the work satisfied, that's on 31st December, we hand over the remaining 10,000 to the. Now notes, these are the notes. Additional information. The following additional information is what relevant. Good. Now, note 1. The interest on the loan was set at 12% per annum. The interest on the loan was set at what? 12% per annum. The interest on the loan was set at 12% per annum. That's the note 1. So note 1. The interest on the loan was set or pegged at what, or against 12%. When I write it like this, per annum, or unless if I do like this, it's also per annum. Note 2. Target PLC can invest, or the company can invest, make it the company. The company can invest the surplus funds with the same bank at the rate of 9%. With the same bank at the rate of 9%. with the same bank, the same bank at the rate of what? 9%. Yes. So they are giving you 9%. Full stop. Start work. Now, after solving this question, don't distort it. I'll update it and resolve it again. I'll bring some stuff into it, make it a bit difficult, and resolve it. So resolve it as it is now. Then let's start. Required. Required. Okay. Required. Okay. Can I put something in to disturb a little? Or after this one, I'll bring those stuff in, right? Okay, let me put the stuff in right now. Let me put the stuff in. Sorry. Let me put the stuff in. Note 3. Note 3. The asset was brought to use. The asset was brought to use on 1st of April 2019 to mark the 5th year anniversary of the company. The asset was brought to use on 1st of April 2019 to mark the 5th anniversary of the company. Good. And the assets have an estimated useful life of 10 years. Estimated useful life of 10 years with a nil residual value. The assets have an estimated useful life of what? 10 years with a nil residual value. Full stop. Now I'm done. Now massage taking. Let's go to the comment there. The question, guys, if you massage it too much, you end up getting it wrong. Good. You end up getting 31 days in April. Now required. First, calculate the borrowing cost eligible for capitalization. Calculate what? The borrowing cost eligible for what? Capitalization. That's the first requirement. Second, calculate the total cost of the assets. And determine the carrying amount of the assets in 2018 and 2019 financial year. Full stop. And determine the carrying amount of the assets in the 2018 and the 2019 financial year. Full stop. I'm strong. Okay. Now that's the end of the question. Make sure that you have the question because I'll take certain part of the question off from the board. So when I take it off, you have it with you. Good. Or you can just take a screenshot of it. Yes. Let me make last changes. Here must be 30. You can make it 30,000. Okay, let's maintain here 10,000. Then here's 40,000. Okay, so I'll make it 40,000. Wait. So it must be equal to 120,000. The total amount taken from the bank. So the first one is 40,000. Good. In fact, in the first situation, if I still maintain the 20,000, it means that they spend only 100,000 out of what? The 120,000 secure from the bank, right? So what will be the cost of the asset? Assuming that I maintain it like this. But the cost of the asset is 100,000, not what? 120,000. That's great. The cost of the asset will be 100,000 because I use 100,000. Yes, I use 100,000. Even though I took what? I took 120. That means the 20,000 I use for other, or I have to return it back to people. Great. Now the note 3. Now let's solve the question. I'll take this section off. So now, so this is it a specific borrowing or a general pool of fund? So this is what specific because they secured loan to construct office complex. So it's a qualifying asset. So first, tell the examiner that requirement A. So borrowing cost eligible for capitalization. Borrowing cost eligible for capitalization. Borrowing cost eligible for capitalization. Good. Borrowing cost eligible for capitalization. So first, all I have to do is bring my Ghana city here and start the interest. So what is the interest? Here the interest must be comply with the three conditions. That's the commencement. One, expenditure has been incurred. When they incur the first expenditure, 31st January. 31st January. So they call the constructor and then give me 40,000 on 31st January. Well, construction started when? 1st February. So the next day. And then the construction kicked from. Okay, that's fine. So that means the interest, we pick 120,000 times the finance cost or the interest rate, which is 12%. So it will be 120,000. Is that? In fact, we pick the loan from where on 1st January 2018. The facility was taken from 1st January 2018. So 20,000 now times 12%. Now how many months? If it's full year, it will be 12 over 12. If it is 9 month period, 9 over 12. So why will it be full year? Will it be full year? Good. 11 months. I like that. Now, even though they took the loan from Yansa Bank on when? 1st January. We're supposed to run from January will be part. But they pick it 1st January, so January will be part. So it ran from January to December. But the construction started from where? 1st February. And if I've gone through the first video, we said that you only have to commence the capitalization when what? When the construction is in what? Is in progress. So January, we won't start the capitalization from January. We start from where? February. Well, that's where the construction will start from. So where they start the construction, if they don't tell you where they start from, then we assume that they started the construction when they pick the money. How we get it? Good. So that is it. So you have to be 11 months. Why? Because to start from February up to when? Construction ended at December. We are done. So you want to be the total interest expense. So the interest expense will be 11 months out of 14,400. So 11 out of 14,400 will be, so 11 out of 12 times 14,400. That'll give us 13,200. That's great. So the total interest will be what? 13,200. Now I am done. I am going to the heartbeats. I am going to the stubborn area. I'm going to the confusing session. So here, be with me and get it. It's not all that difficult. It's not even difficult, not all that. It's not difficult. And I know you for sure that, in fact, you'll get it. So now let's see how best you can do that section. We said that with a specific borrowing, the borrowing cost eligible for capitalization is what? The interest less what? The investment income. So let's tell the examiner that less what? Investment income. Now let's go and compare the investment income. That's where the issue is. Now let's see. Investment income. Now when did you pick the money? You pick the money on when? 1st January, right? So you pick the facility on 1st January. But you pay the contractor when? 31st January, right? So the funds was what? Idle. The whole of January. That 120,000 was idle. So what do? That 120,000 idle and it's surplus. So if you are going to assume that you will invest it at what? The investment rate. What's the investment rate? 9%, right? Good. For how many months? 1 month. Why? For what? 1 month. Because you invest it 1st January and then on 31st January you go and then pick what? You go and then pick the 40,000 from it. So we call that one January investment. You invest that one at 1st January. So 1st January, you invested the entire 120,000. So do your bracket like this. So 120,000 times 9% times how many? 1 out of 12 because you are going to invest for how many months? Just 1 month. This is where the heartbeat is. You invest for 1 month, right? Good. So that will give us, so that will be 9 by 12. In fact, that would be that's 10.8 times 1 out of what? 12. So that will give us 900. Agreed. Perfect. So 900. So I'm going to get interest income of 900. That's perfect. Now what do you do next? Now the money. Let's get a balance here. Let's do something small here. After each withdrawal, let's determine the balance, okay? That will help us to get the answer correct. Please, in exams, they might not do it this way. Might put it in statement form. It will scatter all this in statement version, paragraph by paragraph. So you have to take your time and analyze all of them to get each section's item. So if their funds is 120,000 and they've signed 40,000, so left with how much? So what's the balance left after 31st January? What's the balance left? The balance left will be 80,000, right? Yes, I'll take that. So 80,000, that's great. Great. 80,000. Now this 80,000 too is what? It's also free until 1st of what? March. So they are going to invest this one for how many months? You can't tell me the month. 31st January to what? 1st of March. How many months? 1 month. 31st March to what? From 31st January to what? 1st March. 1. Are you sure it's 1? Are you sure it will be 1? 31st what? January up to what? 1st of March. Okay. Will it be one or two or three? It's still one. Fact is true. That's one. That's great. I was trying my game. Yes, it's one. Perfect. So it's 1 month because 31st was January. January is not part. So February, right? And March 2 is first. So March is not part. So just what? February. Have you seen the game? If you go by three off, you go by two off. One is what? The correct answer. So I'll write here on 31st January, they are investing another money. And that one is 80,000 times 9% times 1 out of 12. And that one also will give us how many months? That's 1 month out of what? 12 months. Because this interest is per annum. This 9% is for the whole year, it's for 12-month period. But we are investing for just 1 month. Good. So that will give us 80 by 0.09, and that will give us 7.2 times or divided by 12. That will give us 600, right? Agreed. Any confirmed friends online? The answer. Perfect. So 600. Wow. Now let's move on. Then on 1st March, what happened? They invested 15,000, so left with how much? What's the net balance? After the 15,000 investment. So left with what? Oh, so 65,000. So left with 65,000. Good. And that 65,000 too will be invested until the next withdrawal. So that will until when? 30th of June. So from 1st March to 30th of June, how many months? Uh-huh. Uh-huh. Here there is very good. Here to be one or two. Will it be 1 month or 2 months? If I add one plus one, I'll get two. 4 months. I like that. I like the 4 months. But I like the 4 month too. 4 months. Okay, I like that. From 1st March up to 30th June, it was 4 months. Are you sure it's 4 months? 4 months. 4 months. Okay, so from okay now let's count. Fine, next time is we shouldn't fix out to count our fingers. So but after our passing, don't write afraid that we count our fingers. So no. So first, March will be part, so March will be one. April, May, then June. Okay, so making what? 4 months. Great. So that's 4 months. So that means they will invest that money when? 1st March, right? Good. So right here, 1st March investment. So 1st March, they are going to invest 65,000 cedis at a rate of 9% times what? Times 4 out of 12. That's perfect. Good. And that'll give us so 65 times 0.09. That's 5.85. Wow. Times 4 divided by 12. That's 1,950, right? I like the answer. 1950. What happened? History of the day. 1950. Something happened. 1950. Something happened. That's where we went for our general election. Fair general election in Ghana. That's yes. Welcome Nkrumah was in prison and then he won by I think 71 to 70 something votes. In fact, I don't know that one. Good. So that was the history of the day 1950. Yes. And then 1951 too, we had another election. Mm. Okay. Okay. I was reminded that that's the same year that we had our SGBC or GNT. One of them came 1950 or 1965. Good. Wow, each of the day. Facts. Now let's move on the game. Have you seen how the game is becoming nice? Now let's see. Then on 30th June, they took 25, so left with what? On 30th June, on 30th June, they took 25 from the 60. They left with what? 40,000. And they are going to, yes, left with 40. Then they will invest this 40 on 30th what? June until 1st October. So how many months? From 30th June to 1st October. How many months? Are you sure it's 3 months? Three, eh? Three, but not four. That one is not bad there. Okay, I like that. 3 months then. Okay, 3 months. Cool. So that is what? 3 months. So yes, it's 3 months. So you start from where? July, August, and what? September. October is not part. Good. So that's 3 months. Hmm. 4 months. Good. So October is not part. 1st of October. So 3 months. Great. Okay, then I'll take that. The cancel one is not cancelled. Now, 1st October. So here the invest in 30th June. Don't mix up the date though. They will invest in 30th June. And here too, what will be the value of the investment? Seems that they have to invest an amount of great. Now they will invest 40,000 cities. So what will be the answer at 9% times 3 out of 12? That will give us 900 again. Wow. That's quite fantastic. I like the question. If I supposed to even end you, I don't mind Fred. It was going plenty. So far you left with how much? The last one they took 30, right? So left with 10, right? 10,000. And that 10,000 will travel how many months? 1 month, eh? Or 2 months. So to travel from where? 1st October up to 31st December. Another what? 3 months. Good. So that one will travel for another 3 months. So now let's see. So now when you invest it when? 1st October. So October 1st investment. Open a bracket. Just the 10,000 times what? 9% times 3 out of 12. And that will give us, so 10 by 9. So that will give us 9 Ghana cities divided by 12. Now times 3. That will give us 2,200 eh, 225. Oh, I thought you give me 50. Oh. You didn't give me 50. Okay, this one times 1,000. Oh, that's why it's 225. Eh? Okay, so 225. You put all of them together. So now let's see. Let's go down. So let's add all of them. 900, 600, 1,005 plus 1950. 1,005 plus 1950. Then plus 900 again. Again 1,800 plus 600. That's 2,000. In fact, the final answer. 4,000. Okay, I'll take that. So 4,575, right? 4,575. So you take it off from where? From 13,200. Yes, the answer is 3,375. Hmm. Let's all confirm. Let's all confirm. So will be 3,000 or 4,000. Okay. Second person is saying 4,575. Okay, so let me also try. So that's 1,800 plus. Okay, everybody have confirmed. So that is it. Great. Oh, good. Now, what will be the borrowing cost eligible for capitalization? The borrowing cost eligible for what? Capitalization. And then we are done. Borrowing cost eligible for what? Capitalization. So borrowing cost eligible for capitalization will be 8,625. That means we pick this figure from where? The 13,200. Then we are done. The space, I don't have enough space here, so I think I have to clean this section and do it there. So I'll clean this section and then do it there. Good, great. So let me take this section off. Now I wanted to update this question, but I'll do that. I'll update the question and then we'll revisit it again. So let's see. So the borrowing costs eligible or to be capitalized, in fact, to be capitalized. It says 8,625 agreed. Now, if you want to get the total cost of the asset, what do? Add the loan amount to it. So the amount taken, or the loan, the facility, or the cost of the construction. We pick 120,000 cities. So therefore, what will be the total cost of the asset? Now the total cost of the asset will be 128,625,000 agreed. So that's the total cost of the assets. Now depreciation must based on what? This asset, right? Depreciation must based on this asset. And you were asked for the carrying amount of the asset as at the end of the 2018 and what? 2019. So when are you going to depreciate the asset? The asset was completed when? December 2018, agreed. But the asset was brought to use when? Brought to use when? April, right? First April. To mark the 5th anniversary of what? Target PLC. Good. So they start using it April. When do you have to start depreciating the asset? Is it when the asset is completed or when the asset is what? Brought to use? I like that. When asset is what? Brought to use. When asset is what? Brought to use. No, when asset is available or when asset is completed. As soon as the asset is completed, you have to start depreciating it. Not when you start using it. They completed in when? December 2018, but they start using it what? April 2019. So the depreciation must start from one year. In fact, in reality, if you give birth to a child and then they say this child because they have 18 years, will the 18 years start counting when the child start talking or walking? No, as soon as the child what arrive. Like your years will start counting as soon as the asset is what completed. Then life will start running from there. So they say when you give birth to a baby, if you have let's say 35 years or 95 years, they start counting as soon as come to that, not when probably start talking. How we get it. So that's how we also work with it in our accounting. So that is it. So the depreciation will start from here, 2018 December. So effectively, it will start from the 2019 January, right? So depreciation will start from there. So let's quickly calculate the depreciation. Here the reducing balance, sorry, straight line balance, the star value is nil. So depreciation will be equal to the 128,625 over 10 years. And to the nearest whole number, it will be what? 12,863 Ghana cedis per year. To the nearest whole number. That's the depreciation per year. Then what will be the current amount of the asset at the end of the first year? That's 2019 December. For 2018, it will still be this. So that's the asset value right after what completion. Then what do? You come to you come to the 2019. For 2019, you subtract first 1 year depreciation from where? From the cost of the asset. Then you are done. So from the depreciation section, IAS 16 will continue. So and thank God we are done with the IAS 16. So I will not even talk much over there. IAS 16 move from there from depreciation. IAS 23 ends as when you calculated this. That's why 23 ends. It ends at the borrowing cost eligible for capitalization. We are done. Great. Now let's continue the game. I'm picking the last question on the general pool of fund. Let's go general pool of fund. If you do have any question, kindly let me know. I want to change to yes, I want to give a work. The same question that we have solved. The same question. I'm adding two notes to it. Note well, two. Resolve it again. The same question, you are going to resolve it again. Just I'm adding two notes. Good. Let me massage the question small. I'm just including two notes. And then you try it again. Please, this one I need a solution. Retry it, everyone. I need two notes. Good. So note one. Note one. I'm including two notes. The last note was note two, right? So we're adding note three to it. But the last note was note two or note three. That was note three. Good. So let's go to note four. Note four. Or the continuation of the note from the first section or from the first question. The first note or the in the month of in the month of March. In the month of March, construction was halted or interrupted. In the month of March, in the month of March, construction was interrupted. Construction was interrupted due to due to employee strike action. Due to what? Employee strike action. And this was settled immediately. So construction continue continue. What's the month after March? April, right? So construction continue first April or began on 1st April. Good. That's the note 5, right? That's the note 4. Now let's go to the last note. I'm adding only 2 notes, then I'm done. I'm adding only 2 notes. I'm adding only 2 notes. Great. Now note 5. Note 5. Note 5. The final work, note 5. The final work was inspected and certified. The final work inspected and certified. Let's make inspected and certified. Took 1 month in the month of December. So the final work was inspected and certified and lasted for 1 month in the month of what? December. So it took place in the month of December. In the month of December. And as a result of that, construction was halted or construction was completed on that day. On that day. Good. I'm done. So you try, then you move up around it for me. Okay. Now let's continue the game. Now we are moving on to general pool of fund. So I'm picking the next question from general pool of fund. I wish that one I will settle like this, but I won't set. I won't pick question. That one is a bit straightforward. Yes. If I should set, it might take time. So let's go and pick already made question. General pool of fund, here you pick or you finance the construction or the acquisition or the production of the qualifying asset from where? Existing funds. So here the first thing you have to calculate is what? The capitalization rate. That we normally call it what? The WACC. How do you get the capitalization rate? The capitalization rate, which is equal to total interest over total debt times 100. That one will not give you a specific interest. You have to calculate it yourself. That's the only issue with the general pool of fund. So let's pick our first question on general pool of fund. Wow. Let's continue the game. Let's go to the borrowing cost. Borrowing cost. Let's look for one general pool of fund and do justice to it. Illustration 7, it shows in advance. Very interesting. Okay, I wanted to solve illustration 7. So I think I'll do that. I'll solve illustration 7. Just that, okay. In fact, the solution is there, so you try it. So let me go and solve the third question, one of them. The one that which does not have solution. One that does not have solution. All of them are very good for you. So 2009 past question. Look at what they're asking. Clearly explain what the borrowing costs. Outline the benchmark and the allowed alternative treatment of borrowing costs for 3 marks. And then determine the borrowing cost of this. So that one is yours in advance. Okay, now let's do question 2. And then that's the end of today's game. Okay, I'll not do question 2. I'll not do question 2. Question 2 is a bit okay, it's a bit straightforward. That's November 2012. Let's do the question 3. The hydroelectric plants. Let me check question 4. It's question 4 to 609. Okay. Wow. Okay, so now let's do the question. I'm doing the question 3. And then you are trying the question 4. Good. Now let's start. Let's start the game. Is it number 1? Question 3. Yeah, I'll call it number 1 limited. Nananam Limited had the following loans in place at the beginning and the end of the year 2010. The loans are there. 10% loan repayable 2015, all of them are there. 9.5%. The balance at the beginning, balance at the end. 8.9% debenture repayable when? They didn't tell us. It's okay. All of that one too, we only have for December. It means that they secure that funds for another qualifying asset, or they secure that fund during the year because there's no beginning balance. That's what we can say for now. Now, the examiner said that the 8.9% debenture was issued to fund the construction of qualifying assets. That's a piece of what? Equipment. So that means that one is for a particular asset. So that one is not free. General pool of fund, we have to use free existing loans or free existing money. Not that if the money is existing, the loan, we've already contracted it and we are using it. That means it's not free. It's not free. Good. And one of them is the 8.9% debenture. They secure it for a particular purpose. We cannot go and pick it. We cannot go and then what? Use it. Because that loan was secured on 1st July. That's 6 months. Just the middle of the year, they secured that loan for construction of a piece of equipment. So that loan is not free. So that means that 8.9% debenture, you're not going to touch it in calculation of the what? The capitalization rate. Now let's move on. On 1st January 2010, Nananam Limited began a construction of a qualifying asset, a piece of machinery for hydroelectric plants using existing borrowings. The expenditure drawn for the construction was as follows. In fact, it was only 2 payments that they made. First, 30,000 January 1st, 2010. Second, October 2010. Good. Calculate the borrowing cost to be capitalized for the hydroelectric plant. So let's see. So first, you have to calculate the capitalization rate. That's the first thing we have to do. So let's go to the board. So here, how? Sorry, the screen is not in. Good. Great. So first, capitalization rate, which is equal to total what? Interest all over the total debt. So let's see. Now here, sometimes there'll be two or more. So first, let's pick the interest here. So I record interest. So what are you doing? We are looking for the capitalization rate. The capitalization rate. That's the WACC, weighted average cost of capital. So interest and debt, we are done. There are two types of debts there. There are two types of debt there, which is what? 10% loan note and 9.5%, 120 and 80. Good. So 10% loan note. So let's start from here. 10% loan note. Into bracket 120. But let's do the calculation here. 10% times 120,000. That will give us 12,000. The value of the debt is what? 120,000. Now let's go and pick the next one. Then we calculate the interest. The next one is 9.5%. That's 80,000. So 9.5% loan. That one need to be 9.5% times what? 80,000. Agreed. And that'll give us so 0.095 times 80,000. One, two, three. Then you get to 7,600, right? So here's 7,600. And here is 80,000. So getting the total, what do you get? You'll give us 19,600. You'll give us 200,000. Good. So what's the capitalization rate? So therefore, the capitalization rate will be equal to the total interest 19,600 or divided by 200,000 times 100%. So what's the capitalization rate? And that'll give us so 19.6 divided by 200. That's 9.8%. So therefore, the capitalization rate is what? 9.8%. Agreed. Good. So that's the end of the capitalization rate. So the worry is to get the capitalization rate correct. Then that's all. So now let's go and calculate the borrowing cost eligible for capitalization. With that one, we just need the amount done. Then that's all. So let me do that one here. So first, after getting the WACC, going through all this process. Second, then the borrowing cost eligible for capitalization. Or borrowing cost to be capitalized. So they took the first funds where they took the first funds January 1st, 2010. So that would take how many months? 12 months, right? So January 1st, here there's no surplus investment, or there's no investment income here. No. If you want to invest, the funds will not be idle. So go and invest it. So January, they pick 30,000. So it will be 30,000 times the 8.9% times it's 9.8, right? So times 9.8% times 12 out of 12. How we get it? So that will give us the answer for me 30,000 times 9.8 2940. So let's go to October. Good. October 2, the peak was 20,000 in 1st October. So 1st October, the peak 20,000 times 9.8%. How many months? 1st October. So October, November, December, 3 months. October, November, December, 3. So times 3 out of 12. And that will give us hmm? So 490. Putting all this together, that's the borrowing cost to be capitalized. Yeah, done. So put all the two together, what do you get? So this one give us 3430. Good. So that's the borrowing cost eligible for capitalization. So what's the total cost of the asset? Who can calculate it for me? Total cost of the asset. The total cost of the asset. Who can do the calculation for me? Okay, great. Now let's confirm the October. Can we confirm the October and let's see. Confirm 490. Now let's see. What's the total cost of the asset? Who can tell me? Total cost of the assets. Total cost of the assets. Total cost of the asset. 3630. So they pick 20,000 and 30,000. So in total they spend 50,000. So plus the so 50,000, that's 30,000 plus the 20,000. That's the amount or the cost of the plant. So now it will be 50,000 plus the 3430. Yeah, we cannot tell the examiner that they should use this money from the first the 10% on. No, we can't do that. Obviously, if you add these two together, you are getting 50,000. No, the first amount guys 120, which can cover all. So that we can just use this 10%. And then we will not go through no. We shouldn't do that. Cool. So that is it. So therefore it will be what? 53,000. 53,000. 53,340. Good. 330. Okay. 430. Okay. That is it. And this is how far the good Lord will bring us. Thank you very much for coming. But please have a question. My question is you are doing question 4 for me. Please try. Question 4 is combination of general pool of fund and the specific. Please try and you smile. And this is how far the good Lord will bring us. On that note, we will continue at the next meeting. So kindly go through all the lecture materials and you'll be fine. If you do have any question too, you can forward it to me. I'll pick it up at the comment section, or you send it to the mail or WhatsApp or any of the social media handles. We will respond to it. Good. So have a nice day. Good.